The Strategic Investor's Guide to Market Crashes. How to Turn Volatility into Wealth. Having spent more than 12 years as an expert in pensions and investments, I've witnessed firsthand how market crashes test even the most disciplined investors. What most people don't realize is that volatility isn't a threat to your wealth, it's actually one of the most powerful wealth-building tools available to strategic investors. The key lies in understanding why most investors fail during downturns and implementing a proven framework to not just survive, but thrive during market turbulence. The fundamental problem stems from human psychology. Research from Dalbar shows that while the S&P 500 delivered 9.6% annual returns from 1990 to 2023, the average investor earned only 5.1%, a staggering 46% underperformance. This gap isn't caused by poor stock selection or bad timing, but rather by emotional decision-making during market stress. When markets decline, fear takes over and investors abandon their plans, locking in losses and missing the eventual recovery. This behavioral gap represents the single greatest destroyer of long-term wealth for both retirees and those still accumulating assets. The solution lies in what I call the strategic wealth framework, developed through years of navigating multiple market cycles. This approach consists of three distinct phases that work together to transform volatility from a threat into an opportunity. The preparation phase happens before any market decline occurs. Historical data clearly shows that markets experience 10% plus drops about once per year and 20% plus declines every 5 to 7 years, so we prepare accordingly. This involves creating volatility buckets, keeping 2 years of living expenses in cash equivalents, 3 to 5 years in short-term bonds, and the remainder in growth assets. You can also establish automatic rebalancing triggers, such as rebalancing whenever any asset class moves more than 5% from its target allocation. When the inevitable market decline occurs, a move into the action phase is made. This is where strategic investors separate themselves from the emotional crowd. Roth conversions become particularly attractive during market downturns. Converting a 100,000 IRA that has dropped to 70,000 during a 30% market decline could save $9,000 or more in taxes for someone in the 24% bracket. You also implement strategic tax loss harvesting to offset ordinary income and carry forward losses for future use. Perhaps most importantly, you increase our dollar cost averaging contributions by 25 to 50% during significant market declines, systematically buying more shares at lower prices. The final phase is the recovery phase, which begins when markets start rebounding. History shows that recoveries can be swift and powerful. After the 2008 crisis, the S&P 500 returned 300% from 2009 to 2021, and the 2020 COVID crash saw a full recovery in just 6 months. During this phase, you implement recovery tiers, rebalancing back to targets after the first 20% rebound, gradually taking profits into tax-advantaged accounts during the next 20% of recovery, and evaluating new allocation thresholds once markets have rebounded more than 40% from their lows. This framework provides a significant strategic advantage. While most investors are panicking during market declines, you'll have a written volatility playbook, predetermined action thresholds, and tax optimization strategies ready to deploy. The result is the ability to maintain discipline when others are making emotional decisions, and to capitalize on opportunities when others are paralyzed by fear. I invite you to take the next step in securing your financial future. Remember, in the history of financial markets, every single crash has been followed by a recovery. The question isn't if markets will recover, it's whether your strategy will allow you to fully participate in that recovery. The next market downturn could begin tomorrow. Will you be prepared?